Good morning, everyone. Welcome to the early riser session. My name is George Goblish. I am from Vesta, Minnesota, where it's nice and chilly these days, so I love to be down here. I'm a board member of the American Soybean Association and also co-chair of Commodity Classic this year. Classic consists of national corn growers, wheat growers, sorghum growers, and American manufacturers equipment. Thank you to Farm Progress and Farm Futures and Channel for producing this session for us. This session has been approved for CEU credits for the CCA program. Sign up to receive credits at the back of the room or click on the QR code on the sign in the back. We also appreciate it if you could fill out the evaluations that you received on your way into the room. Those evaluations will help us determine what kinds of sessions to offer next year. Because as farmers, we select these sessions for farmers. So any input you can give on that would be greatly appreciated. Now I will turn it back over to Farm Progress.
All right, thank you. I'm Mike Wilson with Farm Futures, and I would like to also say thanks to Channel Seed for helping to sponsor this session, along with Farm Futures and Farm Progress. I'm glad to see the group here as a leading kickoff session for the Commodity Classic, and we have a really good one in store for you. Just a couple more of these housekeeping notes. This session is being video recorded, and when we are finished with our speakers here, we'll have two folks out here with handheld microphones, and if you have a question, I'm sure you will have questions, put your hand up so we can get the microphone to you and then give your question. Also then, we are going to have an email to you after the show with instructions on how to access the recording of this session. And of course, please silence your cell phones. So again, thank you for being here. Our session today is one of, we think is going to be a really, really important one because all of our Farm Futures surveys show that while farmers love to farm, grain marketing is one of the things that is a challenge. And obviously we've had some pretty good years the last couple of years, but now we've had a lot of volatility. No one knows exactly what's going to happen. And it's a great, I think it's apropos that we're having this meeting in the state known for its amusement park rides because it's a real roller coaster out there for as far as grain markets go. And we're going to try and help bring a little bit of calm to that whole thing in terms of how to manage your grain marketing strategy. So we're going to be doing that with a couple of guys. Some of you know, have heard them before. Many of you have heard them before. Ed Usset is the grain marketing specialist at the Center for Farm Financial Management at the University of Minnesota. He writes the Advanced Marketing class column in Farm Futures. In 2018, he published a second edition of his book, Grain Marketing is Simple, It's Just Not Easy. Also, Matt Bennet is the co-founder of agmarkets.net. You can visit his team's booth in booth 2943. He is also the Channel Seed Grain Marketing Consultant, and he is a Windsor, Illinois farmer and a blogger at farmfutures.com. So he's also made countless appearances on TV and radio and farm meetings. I know you've probably seen him before. So we're going to have both of these folks come up, give their sessions, and then we'll have the questions afterwards. So let's start with Ed.
Thank you, Mike. Good morning. Welcome back. Good to see you all here this morning. I want to thank Channel Seed and Farm Progress for inviting me back again this year. And I've decided to talk about, well, I go wherever I want to go. And this morning I'm going to talk about old crop prices, new crop prices, and the coming boom in the soy crush capacity. Let's talk first about the old crop price outlook through June. Okay, I'm thinking now about the grain you have, corn and soybeans, in the bin that you put in storage last fall and you're still waiting for the right time to make the sale. I'd like to talk about price prospects for that grain over the next 3 to 4 months. This is a slide I take straight out of my course at the University of Minnesota. I talk about signs of a fundamentally strong grain market. and this, straight out of my course on commodity marketing. And there are three signs I talk about. Rising futures prices. That's where most people stop. They say, well, I see the price going up. That's a strong market. But savvy traders, merchandisers look at two other factors. The other factors are a strong or improving basis. Now, I won't dwell on basis here, but I track a market in southwestern Minnesota, and we've been, the corn basis there, and this is not an ethanol plant, just the ethanol plants are much better. They've been bidding 5 under the March for 2 months. I've got 34 years of data for this point in southwestern Minnesota. That's the best basis in 34 years, in January and March. I know some of you are saying, well, we've seen overs before. Yes, we have seen overs before. We don't see them in January and March, and there are parts of southern Minnesota, Iowa, and certainly Nebraska and South Dakota where overs are the norm right now. I also tell my students to look at the spreads in the market. And here I'm talking about the difference between the May and the July contracts for corn and soybeans. And typically, the May contract is at a discount to the July contract. That's not what's happening now and hasn't been all this year. What we have is an inverse in both the corn and the soybean markets. The May contract is trading above the July. That's the sign of a fundamentally strong market. I went back since 1990, and I grabbed every year I could where on March 1st, there was an inverse in the corn market. And out of the last 34 years, I found a whopping 5 other years like this. Only 5. And you can see it in the highlighted column, March 1, May, July inverse. It's all positive, somewhere from anywhere from 1 to 22 cents inverse. And then I looked at what the cash price did. These are Iowa average prices. The cash price did between March 1 and June 1, 3 months later. That's on the far right. Now, you're going to see that 3 of those 5 years, the market went higher. That's impressive. A couple of those years much higher, and you're going to say, yeah, but 2 years, the market went lower. Yeah, it went 10 to 20 cents lower. Not exactly a collapse. I think this is a sign of a fundamental. I'm starting to relax a bit about the value of cash grain over the next few months. Don't get carried away, just over the next few months. I did the same thing in soybeans. This surprised me. I thought that the inverse, this May-July inverse, and by the way, I can see people already starting to fall asleep. Some of you are like, really? Is he going to talk about spreads? Really? Hey, this is important stuff. Pay attention. Got an inverse. I thought this would be much more common in the world of soybeans. I expected to find 15 years like this. No, I only found 7. 7 years. And in those 7 years where we had an inverse on March 1st, as we had this year, in 6 of those 7 years, the cash price of soybeans went higher in the next 3 months. Now, there's one off year. 2004. 2004 was a post-drought year in soybeans. 2003 was a drought year for soybeans. I'm starting to relax a bit about the value of your grain in the bin. Are we going to go wildly higher as it did in a few of these years? We need a catalyst to make that happen, and I don't know where that's coming from. But I'm starting to relax that, okay, we might be okay for a few months, but that doesn't mean you should relax. You should be thinking about a price at which you would sell that grain. Now let's take a look at the new crop history, because now I'm looking at these specific years. It speaks to a fundamentally strong market today. But how about new crop? Let's look ahead to the pricing of your 2023 corn and soybean crops from late spring to harvest. I took these same 5 years that I've been talking about, and I asked myself, okay, where does December futures go from planting to harvest? And I'm using May 1 to October 1 as my standard here. And you can see that all 5 of those years, the new crop price of corn went lower. Now, Ed, are you saying there's a 100% chance that new crop 2023 December corn is going to be lower at harvest than it is today? There is no 100% in this business. There is no 100%. But it sure has my attention, and it sure has me thinking that I need to be looking for opportunities to price new crop corn. I did the same thing with soybeans. Those 7 years I looked at, inverted on March 1st, and I looked at the new crop November soybean contract over the last 34 years, those 7 years. 5 of those 7 years went lower. One of the exceptions, 2003, was a drought year. So in sum, I'm thinking about this, and I'm putting myself in your shoes. And as I think about the old crop outlook, I'm thinking to myself, you know what, I'm okay. I'm okay with holding old crop. Don't hold it too long, and here I show my friend Hank Holder, who breaks the 11th commandment of grain marketing, thou shalt not hold cash grain in the bin beyond July 1. So keep that in mind. Don't be Hank. But July 1 is almost 4 months away. You got 4 months to figure it out here and figure it out in that time. In terms of new crop price history, late spring to harvest, I show my character Terry Timer, who likes to price grain before harvest. Keep her in mind. Look for opportunities to price new crop in the months ahead. Some of you are thinking, you're talking out both sides of your mouth, Ed. You feel good about prices, but make sure you get something done on new crop. Hey, we're talking about 2 different crops here. Last year's crop and next year's crop. 2 different issues. You say, yeah, but there's already a big, we've already got spot prices up here and new crop prices down here. That can't get any bigger. That spread can't, that inverse can't get any larger. Yeah, it can. Yeah, it can. We've got a handful of years where that inverse, that difference between old and new crop has been large and gotten larger. A year ago, I stood up here about 10 days after the closing of the Beijing Olympics, and I showed a wonderful picture of my daughter and her husband, a hockey player for the Finnish hockey team, and he was wearing the gold medal. Yes, he won the gold medal. A wonderful event, wonderful time, but I can't show that picture again, people. I made a vow to myself a year ago. I said, I got 1 year to talk about this. Year's up. No picture. I'm sorry. Excuse me. As long as we're talking about hockey, did any of you catch the 2022 World Championship? This happened in May of last year in Tampere, Finland, and of course my son-in-law made the Finnish national team again. Let me tell you about this World Championship. It's been going on for over 100 years, okay? The Europeans, many northern European countries have their own professional hockey leagues. They wrap up by the end of April. In North America, the NHL is wrapping up. When you get into early May, you're down to, I think, maybe 4 teams left. Most teams are out of it. Well, countries invite their best professional players from around the world back home to skate for the mother country. So a defenseman with the Tampa Bay Lightning, a Slovak, might go home and go play for Slovakia, and the Latvians, and the Swedes, and the Swiss, and the Canadians will have a roster full of NHL players. The U.S., a roster full of NHL players. It's really good competition. I flew to Finland, spent a week watching some of it. Did you happen to catch who won that? I got 1 year, people, 1 year. I got 2 more months, okay? Okay. let's talk about something very important that I think is going to impact everyone in this room in a big way in the next, it's coming. It hasn't happened. It's coming. This coming boom in soy crush capacity. And I'm going to start this conversation with a rhetorical question. I'm going to ask myself, what drives the golden age? What are the elements that make things good for you in this audience? What makes grain prices good, profitability good? I want to talk about two periods of note. I'm going to go back a century, 100 years ago, to 1914 and 1919, that period. And then I'm just going to go back 10 years, a decade ago, to the period 2007 to 2014. Let's go back 100 years ago, the first golden age of American agriculture. You can Google it. You can read it. That's what they call it. It was the decade leading up to and during World War I. And I just told you what created that golden age. It was World War. World War I was trench warfare. Trench warfare fought in the French countryside. Now, when we talk about grain production in Europe, what is the largest grain-producing country in Europe? France, okay? If you've got a war running through the countryside in France, it's going to impact grain production, right? And not only that, in 1917, they had a little thing further east called the Russian Revolution. That was not a 3-day affair. That took a year and a half, and it upset grain production in Russia and Ukraine, which was part of Russia at that time. So war is what created the first golden age of agriculture. We were an ocean away, and in North America, we enjoyed great grain prices because we were producing grain that others couldn't. We were exporting grain that others couldn't. It was so good that my great-great-grandparents, Anna and Lars Hilden, with 100 acres of very questionable land in western Wisconsin, could afford a camera. And I've got a remarkably large number of pictures from that time period. They had a camera. How about 10 years ago? You remember this. I mean, the wheat growers here, you must remember $15 wheat in 2008. You remember $15, $16, $17 soybeans, our first shot at $6 and $7 corn. What happened there? Rapid demand growth. And in particular, I point to the rapid growth of U.S. corn used in ethanol production. In the year 2000, 600 million bushels of corn went into ethanol production. 10 years later, 5 billion bushels, 8.5 times more. That rapid growth impacted everything. It didn't just impact the corn market. Corn prices went up. The corn market demanded more acres. To get more acres of corn, we had less acres of wheat, less of oats, less of sorghum, less of cotton. Soybeans held their own. But that shifting of acres to meet this rapid demand growth in the world of ethanol upset all markets, and we went higher. A little quiz for you on acreage. In the decade before the ethanol boom, this 1991 to 2000 period, there were 72 to 80 million acres of corn planted each year, a range of 72 to 80 million acres. Now I'm going to talk about the decade after the ethanol boom. The last decade, 2011, 2020, how many acres of corn did we plant in the U.S.? 89 to 97 million acres. We're averaging 14 to 15 million acres more of corn every year now than we did before the boom. Now, what's this got to do with the soy crush industry? The U.S. soy crush industry is expanding. I think everyone knows it. I think you've been reading the press releases. But just as a reminder, in a 15-month period, March 2021 through May of 2022, there were 16 announced projects representing over $3 billion in investment. When all of these investments are completed, and they're going right now, some of this capacity will open this year, but it won't all be in action probably until the first half of 2026. So we're really looking 2 to 4 years out. When it's done, we will increase our soy crushing capacity by more than 25%. Here's my pretty picture of all the plants that have been announced. And I track it. I have not heard anyone say, we've canceled our plans. These are big players. They've got the money to do it. And this, of course, is driven by what? Renewable diesel. The prospects of renewable diesel. This is very odd for the soy crushing industry, which historically has been led by the meal market with oil tracking along. Now these two are sort of on a par. And it's oil driving this expansion. So think about that 600 million bushels, and let's do a little math. The current U.S. crush in the U.S. this marketing year is projected at about 2.25 billion bushels. We expand that by 25%. We're going to need 600 million more bushels of soybeans to feed that expanded crush. You take 600 million bushels divided by 52 bushels per acre, we need 11 million more acres of soybeans. 3 to 4 years out. Does that sound like an echo of the ethanol boom? Does that sound like an echo of the ethanol boom? This is more than a soybean issue. This is an issue for every crop grown, because the soybean market is going to demand more acres. Now, a lot of people, I've heard people say, well, we'll just won't export as much to China. Well, we may not. That'll be dictated by price. But maybe we'll import more soybeans from Canada. Canada is growing more. They're not going to grow 11 million more acres, though. But I don't doubt that a few soybeans will come over from Canada. This is going to roil the market. And by the way, I don't bring this up like this is a big concern. This is good news for all of you. It's good news. By the way, others have done the math. U.S. Wheat Associates back in September said we're going to need 20 to 25 million additional acres of soybeans. I might stop by their booth today and ask them to do the math for me. Show me where that number came. That sounds a bit high. CoBank had an economist said 17.9 million additional acres of soybeans are needed. Now, a little postscript on some figures that don't add up. I've been working with this for a while. Okay, we need 600 million bushels of soybeans 4 years out. But ProFarmer and Dones just 3 weeks ago came out with their winter 2023 outlook. And by the way, I'm not picking on ProFarmer or Dones. I think they do good work, but I looked, they had projections out to 2026, and they showed crush demand increasing by 190 million bushels. That's not going to work. You're not going to have all that expansion and a little more demand and not upset the soybean crushing industry. I've decided that I'm going to change jobs in the year ahead. I'm going to become a lobbyist for the renewable fuels, renewable diesel industry, because I'm going to be busy making sure the mandates go through at several states. So I asked a rhetorical question. What drives a golden age? What creates good times for you? And the answer is war and rapid demand growth. We're in the middle of one today, and we're on the cusp of the other in the years ahead, and that's good news for you. As you came in today, I'd like to encourage feedback. You've got an evaluation form in front of you, and I always encourage people to fill these things out. Tomorrow morning, the early riser session is U.S. Farm Report, right? Tyne Morgan will be there. I fill this out every year for that. I savage her. I savage her. I write the nastiest things you can imagine. And someone did, but Tyne, she's so smart and she's lovely. And oh, hell, she's a big girl. I write terrible things. And then I sign my name and I leave my phone number. No one ever calls. But Matt and I would appreciate your feedback, so make sure you fill this out. And just to encourage you, I'd like to give you some feedback I've had from my students over the years, just a few. Every year, I ask my students to tell me how I've done in the class. I get feedback every year. Do you know why I do that? The university makes me. I don't give a damn what they think. Okay. But it always comes up with some good things. You are one of the best teachers I ever met in my college life. Come and party with me. I can party with you. I can't party with 20-year-olds. That's a headline in the paper. This next one relates to this one, though. Please move the class to the afternoon so I don't fall asleep. It's not easy being a 20-year-old. College, it's not easy because every night is filled with opportunities. And finally, if you think I'm getting full of myself, I can't get over this one. Best comment I ever received. The instructor was rather scatterbrained and confused about the content. So I leave you with that, and for a real take on the market, I give you Matt Bennet.
I've been talking all winter about making the most of a great opportunity. How many of you guys feel like you've had an incredible run over the last couple of years? All right? Several honest people in the room. I'm trying to get this to come up, and for whatever reason, we had it up before, but I'm going to go ahead and get started as we wait on this to make connections. Essentially, we've had 3 straight years where it's paid dividends to do what? Nothing. Would you say Dave do nothing? Is that what you? So he gave Ed a new idea for a character, Dave do nothing, right? Whenever I first met Ed, I was like, what's up with all these characters that he's talking about? But it's good stuff if you stop and think about it. I will get started. There we go. All right, there's my son. He's sitting right over here. I apologize. So success in a roller coaster market. Obviously, when you're on a roller coaster, and the markets are a roller coaster, what's the biggest mistake that we all make? Well, we sell at the bottom because we're trying to do what? We're always trying to catch the top. And so the thing is, this is the type of year where if you're not careful, you're going to be in a position where maybe you don't make any money at all. And the frustrating thing is that you've had 2 straight years of phenomenal profit margins, and I'm afraid the issue is that we can't get those out of our head, right? And so we're going to talk about it as we go through. The grain sell-off, like yesterday, if I had $1 for every person yesterday who asked me, man, what happened to the markets after that nice report, right? I mean, you look at the report, and was the report friendly or was it negative? On soybeans, I'd have to think it was pretty friendly. On corn, I'm not so sure it wasn't friendly as well. I mean, yes, they took some exports out for corn on the U.S. balance sheet, and we're going to talk about that. But the bottom line is, whenever you look, for instance, at Argentina dropping production 7 and 8 on corn and beans, that's a pretty big drop. We usually don't see the USDA do that. I always talk about profit margins. If you call me and ask me, what should I do with my crop right now? Should I wait until sometime between now and July 1? The first thing I'm going to ask you is, can you make money today? And how many of you, if you sold everything today, would make an incredible amount of money on the 22 crop year? I would hope everyone would raise their hands. You guys need to wake up. Now, come on. Got to work with me a little. Risk management is about more than just selling corn and beans right, correctly? Correct, guys? I mean, what's happened the last couple of years whenever it comes to fertilizer purchases or fuel purchases? If you were timing things correctly, it's great. Now, are you always going to time those great? No. But here's the thing, if you were buying fertilizer in August, what should you have been doing this year? Selling some corn. The problem is, for the 22 crop, you bought fertilizer before harvest, right? And we bought it cheap. And then we were rewarded by a market that rallied the entire year. You say, well, that worked so well, I'll just do it all over again, right? What's it going to look like this year? I don't know. I mean, obviously, you already have the high-priced fertilizer locked in, right? That's locked in. So am I improving my balance sheet with higher commodity prices? That's the number one question you got to ask yourself. So the first slide on corn is just kind of a neat joke. If you remember, back in '87, they said, this is your brain on drugs. Well, now you can't even afford the eggs. Gas stoves being outlawed. The only thing you get your hands on is the drugs, right? But why do I bring that up? How many birds have we lost? 50-some million. But you can take that egg and turn it into a full-size bird pretty darn quick. The problem, though, that's the largest grain-consuming animal unit we have is poultry. But beef, I mean cattle, that's the second. What's cattle numbers right now? I mean, obviously, high prices are going to impact high prices. You're gonna fix your problem. And so what the USDA said yesterday, they just dialed down your cash price for corn to $6.60. Beans, what, $14.30? I've been saying fats. Right now they're at $160, $175. They keep trickling up. And I know we're not here to talk about cattle, but I can tell you that I've said all along, 159 or 158 or wherever they were at was $10 too low. Because if the equities markets hold true and the consumer keeps eating beef, I'll tell you what, this fat cattle market's going to be interesting. World corn supply and demand. You take production down year on year, 68.5 million tons. That's an incredible amount of drop in world production. But what's the carry? The carry out goes from 305.7 to 296.5. So the USDA is saying the carry out's can only drop 9 million tons. They're making the assumption that world demand is going to absolutely be decimated. Okay? Now, high prices again fix high prices, correct? Okay, usage, they're saying is down 46.4. Look at this chart here, though. If I extract the U.S., the red line shows you that in 30 years, we have never seen a drop in world demand for corn if you extract the U.S. Now, you can see the U.S., it changes with the times, if you will, and you see a drop, of course. This year, what have we seen happen? What's the one thing that's really struggled that we need to change for corn? Exports. Someone said it. Yes, absolutely. We need that to change. And I thought it was very interesting whenever you look at the U.S. supply and demand balance sheet that you drop Argentina from 47 down to 40 million tons. So you lose 7 million tons of someone who likes to export corn. And then you also drop U.S. corn exports 75 million bushels. Now, I would have been okay with a 25. And let's just be clear, I do not want the USDA's job. I have no desire. Lance, a good guy. These guys that put the numbers together, I don't want their job. But I think it's interesting that we drop the Argentine crop, again, a large exporter, and you take U.S. exports down 75. I don't think that makes sense. But regardless, I'm not the one putting them together. My S&D balance sheet, the farthest three, I don't know, you probably can't even see them, but what I did is I took 91 million acres as my projection for this year. And then I brought demand over, and I kept it constant. And what it shows you is that if you kept demand constant, you're going to be looking at a 176 yield, giving you about a 2.1 billion bushel carryover. Okay? If you had a 180 yield, you'd be looking at 2.442. Now, granted, guys, these are all moving objects. If the market drops substantially, the baseline numbers showed for new crop, your average market price, they're projecting at 560. So if you drop the price a buck, what's going to happen? Demand should improve somewhat. But if you hold prices constant, 660, and you trickle down towards 560, demand's not going to come roaring back overnight as far as the U.S. is concerned. So it's a little bit confusing. There's your basis numbers. So obviously, when you get closer to cattle country, you always get basis. This was as of Jan 1. Basis is always going to be better towards cattle country. Okay? I bring this up. You look at this grower in Liberal at the time, 140, and I talked to this person around the first of the year. I said, what's your cash price? Because we were arguing a little bit. We talked a little bit in the fall as well. But yeah, I said, we've got shuttle loaders going out there right and left. This was during the fall. Originators kept buying corn. There's going to be more corn leave Illinois and go out west than we've ever seen before in a marketing year, because they have to get the corn to them, right? And he said, well, during fall, he said, well, what do you think I ought to do with my corn? My irrigated corn's running like 210, 220. And I said, well, what's the feed yard paying? Because that's where he hauls all his corn. $9. I said, I'm no math major. But here's the question he's got to ask himself. If you put $9 corn in the bin, what are you looking for? You know what I'm saying? You got to ask yourself. A lot of us are sitting here thinking, man, I hope he doesn't call on me, right? But I've had a lot of folks tell me what was wrong with $7 corn. And if your yield was really strong, sometimes, I know you want to use your bins. I totally understand it. But if you're looking at $300, $400, $500 an acre net profit, I think we can overcomplicate things at times. So, and here's the thing. Ed pointed this out. Guys, whenever there is an inverted market and basis is strong, I can tell you one thing as a fact. Today they want your corn. That's a fact. I don't know about tomorrow. A lot can change about tomorrow, but it's a fact. So we'll start out with another joke here. Anybody ever seen a 10-year challenge that these kids post? This is what I looked like 10 years ago. This is what I look like today. This is the one that makes the most sense to me. I don't know if anybody understands this. I didn't know when I took my son fishing last summer that I was going to need my readers. Have you ever tried to use your phone to blow up a menu to where you could read it? I was trying to use my phone and put fishing line through a freaking eye of a hook. That's not the easiest thing to do. So that's got nothing to do with soybeans, I realize that. Production up 17 million tons, whereas carryout's only going to go up what, let's see, that's world soybean production. I haven't got to the carryout. I just want to show you Argentina at 33, and I'm going to show you specifically the original projection. The original projection was 51. So we're down 11 from 22 at a 33 million ton crop in Argentina, okay? Guys, does the USDA usually take large chunks out of production? No. Pay attention to this. Pay attention to this because they dropped corn substantially as well. I mean, corn went down 7, beans went down 8. Corn was originally projected 55. We're down to 40. So this is a pretty interesting development we've got. But whenever I look at carryout, essentially I'm holding stocks constant. If I'm holding stocks constant whenever production's gone up substantially, guys, demand's still awfully good. They're saying that total trade's going to be up around, usage is going to be up around 9 million tons. And so demand's still quite strong for soybeans. I look at the U.S. supply and demand, 210. Crush went down, and people keep asking me, why in the world would crush go down? It's more of a logistical issue, and I'll show you why here in just a second. But whenever I look at, for instance, exports go up, of course. Why would exports go up? Because originally all of us were saying, you know what, if Brazil has this monster crop and Argentina doesn't have a huge crop, Brazil's going to more than make up for it, right? I'll tell you what, whenever they're down and look like they are right now, it looks like it could be an absolute wash. I'm at 88.5 on my acreage for soybeans. If I take 88.5 with a 51 yield and I hold demand constant, it gives me about 350. All right, so, you know, that's a pretty decent yield. But bottom line is right now, guys, the bean situation is pretty tight, both U.S. and domestically. If I look right now at U.S. beans, why we're not going to see a whole lot of exports? Of course, there's a lot of exports available out of the southern hemisphere, but here's the thing. Our prices are the highest on here. U.S. Gulf prices are the highest beans in the world right now, at least whenever you compare it to your major exporters. And so you're not going to see a whole lot of exports from this point forward, but fortunately, to this point, we've done pretty good. That is over the course of time, the export business we've lost. Okay, so what you've seen is where South America is almost exporting twice what we are. Okay, so if you look at it, does this concern you? And as Ed said, you're probably going to see price dictate what China does, of course. But the bottom line is this. If we're losing export business, what about renewable diesel should we be thankful for? Because we're going to gobble up a ton of bushels. What I would like to see is the U.S. producer not go to sleep at night and worry about the export business we're losing because we're using beans domestically. And I like to see that. That's your crush margins. Okay, so you look at the crush margins through the end of January, and you say, well, that's 270, 350, 360, 370 per what? per what? Per bushel. If you're a soybean crusher, what do you want to do? If you're making 360 a bushel, what do you want to do? That's not a hard question, guys. You want to crush more beans, correct? And so I didn't go into a lot of detail here because Ed sent his slide deck. I didn't want to send him mine. It was a strategic move, right? But no, he sent me his, and I took some of this renewable stuff out. But guys, here's my question for you. What have we always crushed beans for here in the U.S.? Meal. What are we crushing beans for today? And meal. That's why crush margins are what they are. In the past, you had to figure out what to do with soil. That's not the case anymore. So the thing is that if you want to explain why it's so popular, I mean, 75% reduction in emissions. That's a big deal. It works in cold temperatures. How many of you guys tried to burn B20 when it came out in the winter? That was fun, wasn't it? No, it wasn't fun at all. This works well in cold temperatures. And the other thing I'll point out is this. All of the plants Ed showed, who's investing in these plants? Big oil. So in California right now, they're burning pretty much all renewable diesel. Okay? So let me tell you about renewable diesel real quick. B20 is, what's the percentage that you can put in of soybean oil? It's a pretty easy question. 20, right? What about renewable? It's up to 100. So if everybody in California is burning renewable, you could be burning up to 100% soybean oil. Okay? It's a pretty big deal. Now, you say, well, what about EVs? So I've got a slide for you. I just want to show you about EVs real quick. See if you see the irony in this slide here. It's Tesla's roadside assistance vehicle filling up with some fuel or gasoline, most likely. But regardless, I'm sorry. I'm just trying. It gets to the point of the presentation where some of you are like, I got places to go, and you're losing interest. But all right, as of Jan 1, July beans were $1.51 higher than they'd ever been as of Jan 1 this year. $1.51. Okay? I know a lot of times people say, well, you should never sell grain in January or February, right? Well, if it's $1.51 higher than what it's ever been, I might consider doing so. You know what I'm saying? I mean, November beans were the highest price they'd ever been as of January 1. Same thing with D's corn. July corn, it was the third highest. But bottom line is, we need to pay attention to stuff like this. I know what the seasonals mean. I know that you typically don't sell in January and February, but I also know that if you can't make money at 1533 beans, we've got some serious problems. Correct? That's the bottom line. Insurance prices. $5.91 for corn this year is not the same as $5.90 last year. Why is that? Input prices. Absolutely. Have to be cautious. I'm going to go into detail on that. 1376 on beans isn't so bad. I want to look at three different rallies, 08, 12, and 22. 2 years before the rally, you saw a nice, strong uptrend, as you can see on these charts. You start building demand for a variety of reasons. The markets went up. The year before the big rally, the markets plateaued. And the market's trying to figure out, what are we going to do? Okay, so you plateau after this nice strong incline. What do you do the year of the rally? I think we can all remember what happened in 2008. You skyrocketed into pollination time, and then you dropped off a ledge and you didn't come back. And then in 12, you said, I'm not going to let the same thing happen to me that happened in 08. I'm selling into this rally. Problem is, it didn't rain in 12. Okay, but that's not the object of this discussion. You don't know what's going to happen the year later, right? Well, I want to look at what happened in the past. 2009. What happened in 2009? Well, the market continued to go lower. 2013, you had what I would call a series of lower highs. The market continued lower, correct? I don't know what's going to happen in 2023. What I do know is this. If you do not have a plan, and the same thing happens in 2013, you're going to be darn upset that you didn't have a plan. Correct? I would hope so, because you've already got the inputs locked in, guys. And so what's it look like whenever you overlay these charts? This is the continuous chart from 2013 versus the D's chart as of now of 23. And guess what? They're looking pretty correlated to me. I'm not saying that it's going to continue on that path. But typically, when you go to really strong, high prices, what happens? You lose some demand, supply increases. I mean, did the U.S. farmer make a lot of money on corn if they raised any crop at all this year? Do you guys think anybody else in the world did the same? And so what do we all want to do? The same thing as the crushers, correct? More. That's the answer. So let's look at heating oil real quick. Why would I put a heating oil chart up here? How many of you guys contracted diesel fuel last spring for last fall? I know some of you did. Were you happy that you did? Of course you were. My dad calls me from Florida. He said, I thought that our fuel bill should have been lower. You told me you contracted a bunch of diesel fuel. I said, I did contract diesel fuel. Well, why is my fuel bill higher than last year? I said, we only contracted half the diesel fuel. Well, why in the heck did we do that? I said, because that's what you told me to do. But if you get to a multi-month low and you don't want to contract with your fuel supplier, you can buy heating oil futures. That's what a lot of folks do to hedge diesel fuel. If you look at nat gas, this market was on an absolute, what you call, death spiral. I don't know what you want to call it, but we finally found some footing. But you say, hey, down here at 270, 280, that means we're going to have cheap what? Anhydrous, right? Here's the problem. Everyone's full of anhydrous today, and they're not full at 270. And they're not full at 220. They're full at 5 and 550. Last fall's prices, after everyone was done putting anhydrous on, correct? And so if I want to be flexible, if I've got the ability to take anhydrous on the farm, I'm going to be in the driver's seat. I wouldn't be the first one in the co-op this year. If I don't like doing side dress, well, good for you. Rethink it. Maybe do things a little differently this year. Because when I look at fertilizer prices as of Jan 1, we would all agree 23, we've got way more money invested, correct? But as of Jan 1, you actually saw big relief because last year as of Jan 1, prices were sky high. So what does this once again mean? The timing of your purchases is very important, first of all. And second of all, if you're buying high fertilizer prices, you're doing so with the mindset that corn prices are going to stay high. That's not a great mindset. Lock some of it in, at least the ratio of corn to fertilizer. U of I said this year on the farms that they tracked for 2021, you're looking at a 446 project, or that's the actual income for 21. 22 projected is 350. For 23, they're projecting 81,000. That's in the state of Illinois. All right, how'd they come up with these numbers? Well, if you look here at the top line, operator and land return skyrockets in 21 and 22. Their projection for 23 is it's going to go down substantially. Why? You've got high prices locked in as far as inputs go and no guarantee on the output. All right, so you look at the land costs. Obviously, are we going to get a nice goodwill gesture from our landowners that since prices are so high on inputs, they're going to take our cash rent down this year? Anybody have their cash rent? Because if you raise your hand on that one, I'm going to shake your hand afterwards. Because when you have extremely good profits, what do you see? Yes, absolutely. Rents go up. And so what do we have? Farmer return at the bottom. You see 373, you see 343, and you see 72. This is on corn. And you say 72 stinks, right? I remember 21 and 22, and I am not settling for 72. Well, guys, go to the far left at the bottom and see what those first 3 years were. Negative 35, 34, and 8 was the farmer return after land costs. Now, maybe we should consider settling for 75 or a measly $100 an acre. You know what I'm saying? Because that's the long and short of it. The same, they put this out this week. The average Illinois producer in that part of the state is going to spend over $100 an acre more than they've ever spent putting a crop out. Okay? And so it's locked in. Be careful. So the interest costs. Here's the thing. New operating notes are starting soon. You're going from 3 and 4% to 7, 8, and 9%, correct? What's it cost to hold on to the grain? Stop and think about this. Right now, it's going to cost you about 10 cents per bushel per month for soybeans just to hold on to them because of the cost of money. So you got to ask yourself, why am I holding on to them, right? You can transfer ownership to paper if you want. Same type of thing for corn. But I'll tell you what, whenever we start talking about interest costs, it's going to change a lot of things, in my opinion, because budgets are going to look different. If any of you guys follow me, my wife who's here, we've been doing a kitchen project. And I don't know how many of you guys have ever done a kitchen project, but it's turned into a beast. I can tell you that right there. So I just had a little thing here just to kind of show you what my wife deals with sometimes. My wife just stopped and said, "You weren't even listening, were you?" And I thought, man, that's a weird way to start a conversation. I don't know if anybody can identify with this, but you can give her your condolences afterwards if you want. I usually kind of poke some fun. I thought I'd poke it at myself today. But here's one of the last things I'm going to show you. Yield. From 91 to 21, over that course of time, the average bushel per acre increase was 2.0253 bushels per acre. 1.28 from 13 to 21. Now, obviously, if we would have taken this study one more year, we would have seen that 1.28 is even lower. Guys, is the problem the genetics we're planting, or has the problem been Mother Nature's been kind of a rip lately? Or a combination? But I can tell you that bushel per acre increase is somewhere probably between 2.0253 and 1.28. And here's the deal. What if we plant 91 or 2 million acres and you get a 185 yield? What if we go above trend? Because trend is 181.5. Have a plan in place. What do you think the markets are going to do if you see a 182, 183 at 91 or 2? $5 doesn't hold that market. It doesn't hold it. So if you want to get a copy of my slide deck, you can take a picture of that, or our booth's 2943. We're actually going to have a thing where you can take a snapshot of this if you want whenever we get there. I have to have some time for questions. Don't transition off of that just yet. I do have one more slide. It's my favorite slide. This is my risk disclaimer. You cannot hold me liable for anything that I said this morning. All right, we're good.
These guys a hand. All right. Thank you, Matt. Thank you, Ed. Thank you for making grain marketing entertaining. So we have a couple of our folks out in the audience with microphones. Jacqueline's over here, and Willie is somewhere around here, back there. Okay, put your hand up, and if you have a question, and we'll try and get you a microphone. Certainly you have some questions. Nobody? Have you got it all figured out? I would like these guys to comment about Ukraine, and it seems to me that as long as we've got a conflict there, we are going to keep seeing pretty good prices. Or is that, would you say that's accurate or not?
Well, Mike's asking questions now.
Well, I talked about war, and here's the sad part. I mean, over the last 100 years, there's always a war going on in the U.S. I'm reminded of my graduate school days. I had a friend from Ethiopia, Kwame, and he looked sad one day, and I said, Kwame, what's the problem? And this is like in the late 70s, and he said, Ed, today in the world there are only 2 wars going on. I said, oh, yeah? He says, and they're both in my country. It doesn't affect things. Just the fact that there's a war going on really doesn't affect grain supply and demand unless it affects a big player in the world of grain supply and export. Ukraine is a big player. Ukraine is the breadbasket of Europe. This is not a new term. It was recognized as such 2 centuries ago. And as long as there's war going on in Ukraine, uncertainty there, it's a concern, and it's going to have an impact on our markets.
Yeah, go ahead. That's fine.
Yes, you know, if you go back into the early 70s, and when world demand was exceeding world's production and all of that, and then we proceeded on to having surpluses that we didn't know what to do with, and it seems as though we're evolving yet, and you know, you talk about all the things that will increase demand and all that. Is the world going to be able to keep up with it?
Am I on? Let me back on. Okay, we good? You know, I think whenever it gets right down to it, there's one thing that I didn't bring up, and Ed could have talked about this as well. But sustainable aviation fuel, the folks in the fuel sector are sharing with me that the volume we're going to run through is going to be even greater than renewable. And it could be the savior for this ethanol business. But are we going to get into a food versus fuel debate? Maybe that's what you're getting at. I mean, my personal opinion is that whenever you start gobbling up all of the vegetable oil, at some point, if vegetable oil prices skyrocket, you're certainly going to have some issues using oil for fuel. Whenever you look at, for instance, what I'm personally looking at, old versus new, I do think that your carryouts could swell substantially here in the U.S., but at the same time, if everyone tells me, hey, I love planting corn, and then we're going to plant 10 or 11 more million acres of beans, why would we want to do such a thing? Because if you're harvesting 60, 70, 80 bushel beans, and you're selling them for $14 or $15, I think that works pretty good, right? And so you could have a very strong tug of war whenever it comes to acreage. I don't think that we're going to be looking at any major plethora of overabundance just yet. I think you're going to have to get North and South America both having good crops at the same time that you don't have such issues in the Black Sea region to where you can count on big production there. That's my opinion.
Any more questions out here? We have a few more minutes. Right here, right here. We have a couple right here. Willie, okay.
It's a law. I got guys in the back. We both in front. You could ask this question a long time ago.
I know it. We both need exercise. Are we on?
Yeah, you're on.
So, one of the things that's difficult as a producer is trying to wrap your head around the old crop at $15 and the new at $13 and have a marketing plan. How do you divorce yourself from that mentality to fear of missing out or whatever you want to call it? It's very difficult.
It's very difficult. And by the way, this question is coming from one Chris Johnson. I had his daughter in my class a couple of years ago, and Chris, your daughter's a lot smarter than you, but I'll just leave it at that. Chris, I don't have a good answer for you, but they're two different crops, and you have to repeat it to yourself every day. They're two different crops. Don't confuse one with the other. We get in this situation where today's price is up here and the new crop is down here, and you're thinking the new crop has got to come up to meet it. And in fact, more often than not, it's this price that comes down to meet the new crop. So I don't have a good suggestion. Maybe next time we bring a psychologist and a couch, and one at a time you can lay down and we'll talk about these issues.
Chris, here's what I'm going to tell you real quick. I try to market in black and white. I just want to know, what do the numbers mean? So obviously $14 new crop beans might mean something totally different than $16 old crop beans, but if I've never had a chance before we planted beans to sell 1380 beans, I got to ask myself, why am I not selling them? And so I run the math on it. What's my APH look like here? If I'm buying crop insurance, what kind of strategy can I use to accentuate that crop insurance program, lock in a worst case scenario, leave flexibility to go on higher if the market rewards you with it. And the third thing is, don't try to hit the high like that roller coaster. If you try to market for the high, you're going to fail 9 times out of 10.
Hold on, Willie. This will have to be the last question. I'm sorry, but we need to move along. But Ed's going to be circulating around here shortly after, and of course, Matt will be with AgMarkets.net booth, right?
Correct.
So thank you all for coming. Go ahead.
In the last 2 or 3 years, we've seen more black swans than I've ever seen in my lifetime. What are the possible black swans in the next 12 months?
Oh, Lord, I'm not that smart. The reason they're called black swans is because we don't expect them. I mean, although I know what you're talking about. We had a trade war, we had ASF the following year, we had COVID the following year. Any one of them is story of the decade, and we had them 3 years in a row. You know, I don't know where the next black swan comes from. That's why it's a black swan.
Let's say China gets into a conflict, okay? We all know there's possibilities there. My personal opinion is that the soybean market doesn't act like corn and wheat did with the Black Sea region conflict. I think it's the opposite effect, actually, because of the perceived lack of demand, and that maybe they've actually stored up some soybeans and they're in a good enough position to go in and do something like that. If that's the black swan event, I'd be pretty concerned about soybean prices in that short run.
Well, thank you all for coming, and I hope you have a great Commodity Classic. And thank you to these guys. Appreciate it.